Hello everyone, I'm Kate Hill and welcome to an advisable special monthly city market update. We really do try and give you honest and balanced commentary and content here. So before we do anything else, please subscribe to our YouTube channel and hit that notification bell so that you're not missing out on all our further news updates, suburb analysis reports, and quality and independent hints and tips around the property markets. We really care that you do well with property. If you're enjoying our free content, then please click on that like button too. If you're interested in specifically the Melbourne property market, then watch our video here, and I've also listed it in the description below. Now, today's report is about the Sydney property market. I'll talk about the city, the regional markets, and I also have a warning for you about what not to buy in Sydney right now and why. So stay tuned. So Sydney. While Sydney is still showing a high level of resistance against the pandemic forces, the city is generally finding it difficult to withstand those negative impacts. Sydney, like Melbourne, has been hit by the shutdown of international tourism and overseas migration. And this is particularly evident in the rental market, with vacancies rising, rents falling in many locations, notably in the inner ring areas. More on that a little bit later. Regional New South Wales, however, provides a number of contrasts to this. Vacancies remain low in most regional centres. Rents have not fallen, they're tightening, and there are areas where prices have continued to rise. As most of us know, in the last couple of months, we have seen an increasing number of COVID-19 community transmissions in Melbourne, and then also small rises in the Sydney area. While right now, Sydney has not seen the return of high COVID cases or a return to the lockdowns experienced in Melbourne in the past few weeks, there is no doubt that consumer confidence has taken a hit as a result of the fear of a second wave coming to Sydney also. So real estate listing numbers have been reduced as people have been in somewhat of a watch and wait mode. This has changed over the past few weeks though, as we have not seen a continued rise in COVID cases and consumer sentiment seems to have settled down again. Auction numbers and new listings continue to rise, and they remain quite strong for this time of year, although auction clearance rates have eased to around 60% over the past few weeks. The clearance rate at the same period last year was above 70%, although with a lower number of auctions as the market began its recovery at that time. Sale prices do remain higher than a year ago in most parts of the Sydney metropolitan area though, but there has been a gradual decline in recent months. The rate of decline has eased though in August, with values down only 0.5% over August, while the decline was 0.9% in July and 0.8% in June. A number of Sydney suburbs have achieved significant growth year on year, driven by a strong performance in the second half of 2019 and early 2020. Take, for example, the Petersham market. So according to realestate.com.au, this suburb recorded a 32% annual increase in median house prices, followed by Bexley with 29%, Erskineville and North Willoughby with 28%, and Bondi, which grew 27% year on year. CoreLogic data also reveals some suburbs have not performed well most recently, with median house prices down 5 to 6% this year in suburbs such as Sutherland and also Grays Point. Some southwestern suburbs also took a bit of a hit, with Cabramatta, St John's Park, Bossley Park, Landsvale, Canleyvale experiencing price drops between 3 and maybe 4.5% since the start of 2020. But really overall, these relatively small decreases in medians are quite moderate under the circumstances and show that Sydney markets overall do remain resilient in terms of prices. For the investor market, vacancy rates in Sydney's outer ring, where the majority of renters are permanent tenants and the people who live there are less transient and therefore less impacted by the decline in Airbnb bookings, for example, those suburbs have defied the downturn and have actually dropped slightly by 0.1% in that past quarter. The overall decline in Sydney rents has had a significant impact on returns, of course, with gross rental yields for Sydney units as a whole now at a record low of 3.6%. According to Domain, the number of advertised rentals jumped almost 13% across Sydney between March to June. But that rise has actually been localised when you drill that down. More on that also later. So we can say that much of the Sydney real estate market has defied these doomsayers who were predicting 30% drops by achieving double-digit price growth in the past 12 months, despite that decline in recent months. Prices have remained resilient despite increased unemployment levels and significant residential vacancies in some locations. Coming to that regional market, many locations across regional New South Wales entered the virus shutdown period with rising property markets, and the best of them are placed to perform well in the recovery phase. Many regional New South Wales areas have had very few coronavirus cases, some have had 0 cases. And many rural communities have local economies well set up to do well in things like a pandemic period. The key question, of course, is which of these locations are best situated to withstand the impacts of the virus shutdown and emerge strongly on the other side. Those who know us well and those who read Terry Ryder's reports, for example, will know and anticipate me saying that the answer absolutely relates to the makeup of the local economy, the level of vacancies, and the degree of spending on infrastructure. It may seem and sound obvious, but you'd be amazed at the number of buyers and investors who don't consider these facts. So I will take this opportunity quickly to point you in the direction of my video about the best questions to ask while researching great areas for property buying right here. Take, for example, the Newcastle and Hunter region. The Newcastle and Hunter region property market has continued to hold extremely steady through the pandemic. Whilst buyer uncertainty has not stopped investors purchasing property, the volume and quality of properties on the market has not fully recovered, but it's on its way. Property prices in Newcastle and Lake Macquarie actually rose a little in the last 3-month period, even with the area shedding 24,000 jobs. Sales agents have noted that investors from outside the region are showing interest in purchasing investment properties. With the pandemic and with people still working from home, many property buyers looking for a sea change have Newcastle and regional properties under the microscope. We've reported on this before. As most of us have all been working from home, travelling into work only sporadically, if at all, and employer attitudes toward this have and are changing. Some will seek to make this sea change, tree change, permanent. People from Sydney are moving to the regions such as the Hunter Valley, not only because of relative housing affordability, but also because of lifestyle, access to transport and employment opportunities, and they can still travel into the bigger cities for 1 to 2 days a week if that's actually necessary. So centres with diverse economies, lifestyle facilities, vibrant job markets, they will continue to thrive. I don't do this very often, but I am now going to come to you with a warning what not to buy right now here in Sydney. Sydney's unit rental market, as well as Melbourne's, has been one of the hardest hit in Australia during this pandemic, with vacancy rates rising and rents dropping. While rent levels for houses have remained fairly stable in the past quarter, certainly, unit rents have dropped by up to $50 a week and more, with eastern and northern suburbs also affected. As we have reported before, a substantial drop in foreign student numbers and that shutdown of overseas tourism during the COVID-19 pandemic has led to growing numbers of landlords seeking to secure permanent tenants for properties in the inner city areas of Sydney. We then also add floods of Airbnb listings to the pool of available rental listings, as there are no tourists filling that market. So obviously you've got this huge extra supply and hugely decreased demand. The very centre and also inner ring suburbs have also seen an increasing supply of properties as new unit development completions have continued to hit that market. New unit completions are also impacting the supply in some middle ring suburbs, and demand levels, as I've just explained, are just not increasing at the same levels as supply because immigration has been stopped, foreign students can't come in, and it's likely to be impacted for some time to come. Vacancy rates have risen sharply as a result and have increased each month for the past 4 months, according to the Real Estate Institute of New South Wales. Our Real Estate Institute in New South Wales says that the average vacancy rate across Sydney is now 4.5%, but the inner ring suburbs are higher, with a vacancy rate of between 6 and 16%, which is a 20-year high for this precinct. Advertised rentals increased by 43% in the city and the east and by 29% in the inner west, as many short-term Airbnb-style rentals have tried to convert to longer-term leases and border closures have stopped international tourism. So this sharp reduction in rental demand within these locations is resulting in much lower rents because they're all competing for a lower pool of tenants, extended vacancy periods as explained. This, of course, ultimately has a very negative effect on sales prices, given that particularly investors are concerned about rental returns and also whether there'll be any upside to capital growth in the next few years. Heron Todd White list an interesting example of this in their most recent report, whereby a 2-bedroom apartment at O'Riordan Street in Mascot in Sydney previously sold 4 years ago at the peak of the Sydney boom, really, April 2016, for $800,000. It's recently been sold during July by the same agency for $790,000. They suggest, and I agree, that this result demonstrates how some properties within certain high-density locations are underperforming when compared to owner-occupier style properties, such as perhaps freestanding homes or larger modern townhouse terraces within the surrounding areas. Current asking rents for 2-bedroom units within the same building that example just sold in range from $600 to $700 per week. Now that's just the list price. It doesn't mean that rent will be achieved. Given the number of units for rent in that area and a vacancy rate of over 7%, those asking rents and yields are likely to drop further the longer properties stay vacant. So you are going to see a lot more of this, and this, and this. So everyone, please do not fall prey to unscrupulous spruikers. They are out in force at the moment, particularly. I can't stress this strongly enough. As we head into spring, traditionally a strong period for the buying and selling of real estate, we continue to monitor all our property markets closely to see what happens as government stimulus packages lessen and the banks review borrowers' loan repayment holidays. Make sure that you are not missing property market trends, news, suburb analysis reports, and lots of hints and tips around buying and owning property. Please subscribe to our channel, leave us a comment below, let me know if you've got any questions or concerns or suggestions as to content that you might like. Don't forget to please hit that like button too. Check out our website for more details on our services and how our advisors and buyers agents can help you. And I will see you soon. Bye.